GETCRACK. Wake up, motherfucker.
One of the things that I think when I speak to the people who went in on this deal, Kelly, is they're talking about what the backlog is and what the backlog is in relation to orders lost. And apparently both are pretty good for you. Can you give us some numbers?
Yeah, so we've got across our defense and commercial business roughly $500 billion of backlog. And you know, one of the things I've done as I've come into the new role is met with many of our customers, and they're all one thing. 100% of our customers are supportive of Boeing. They need us, they want us to succeed, and they're going to help us succeed. So this is not a story about losing market support for our products. Demand is tremendous. This is a story about us getting our act together and being able to deliver the aircraft to the demand that they need.
Okay, so I hear aircraft. In December 7th of 2017, Dennis Muhlenberg was on Mad Money, and he talked derisively, actually, about Elon Musk in terms of the space program, and said he was committed to have a much better space program than anything that Musk would do. Can you really suffer through that distraction right now when your company's on the line, sir?
Well, look, Jim, it is what it is. We've got to manage through the programs that we have. I would say across our defense business, we've got some pretty tough contracts, and that's been well publicized. And we've just got to manage our way through those. I will tell you what I'm focused on is making sure that we're doing the things on those programs that are under our control, and we're executing the business. Strong program management, strong systems engineering, getting closer to the customers to work these programs and make sure they're a success.
Mr. Ortberg, it's David Faber. Just a couple of quick follow-ups to some of the questions Phil gave before he resumes. On the restoring of the balance sheet, you sort of, answered in terms of what you may do potentially. Can you give us any more clarity in the investor base? Is it going to be your expectation of a $10 billion equity raise, perhaps $5 billion in a mandatory convertible preferred? Will it be sooner rather than later in the sense of in the near term?
Yeah, look, I don't want to go into the details of that. I'll just say that I feel quite comfortable with our plan, and we're executing that plan. And that plan will give us the liquidity we need here for the short, midterm for our business. And of course, the long term, it's all about getting our production rates and primarily our 737 MAX production rates increased. And then life gets a lot easier from a cash flow perspective.
Yeah, I'm sure Phil's got some follow-ups on production, but if I could just come to you on culture, because you, in your first answer, I think you said culture is not a poster on the wall. What do you do to restore culture there? What does that actually mean? What does that undertaking look like from your perspective?
Well, it starts with the values, and it starts at the top of the company. So we've got to make sure that everybody in the company understands what we value and what those values are, and everything what we do follows along with those values. So we're putting in place a reevaluation of the values across the company. It also means getting people a lot closer to the business. We need to be in the engineering labs. We need to be in the factory, talking to our people, understanding the challenges that they're facing. I know what good culture is. My previous company, we had a good culture, and I think this company has had a good culture. We just need to recover that, get back to what everybody wants Boeing to be, this iconic company building great aircraft and defense systems. And everything I see, we can do that. We just got to focus on getting back to our roots.
Is in Arlington, Virginia, with Kelly Ortberg, first national TV interview since taking the job. Hey, Phil.
Carl, how are you today? Kelly, thank you for joining us. Carl set this up by talking about the huge loss for the third quarter. You've got a slew of problems to tackle. And I think a lot of people look at Boeing right now and they say, how long will it be until investors can say there's no more string of bad headlines that are going to come out, something that will make people say, here we go again with Boeing?
Well, I've said there's no silver bullet. This isn't going to be fixed in one fell swoop. We've got a lot of issues here that we're dealing with. The first thing we've got to do is stabilize the business, and obviously getting through the IAM strike is the first big step in doing that. But then we've also got to shore up our balance sheet so that we have a solid balance sheet to manage the realities of our business going forward. I think from a longer term perspective, getting focused on executing on these development programs is critical for our company. And then underlying all that is culture change. And we're off doing that. We're reevaluating the values in the company. And we really need to embark on a culture change that is something more than just a poster on the wall. It's really going to guide how the company behaves day in, day out.
You're sitting on about $10 billion in liquidity right now at the end of the third quarter. You've got this machinist vote happening today. How critical is it to your bottom line that you get a deal locked in, if not today, but very quickly with the machinists, or else it forces you guys into some tougher choices?
Well, I think we've got a good liquidity plan, irrespective of the near-term outcome here. So I feel pretty confident in that. But the vote is important. It's more important in terms of our long-term getting back to building airplanes, delivering good airplanes. And so we've worked really hard to find that overlap where we've got a deal that the employees can feel good about and the company can be successful going forward. So I'm very hopeful for the vote. We'll hear later on tonight.
You've spent some time on the floor. You've talked with some of the machinists. Can you understand some of the venom that they have expressed towards Boeing for the way relations have gone over the last 20, 30, 40 years?
Yeah, there's a lot of history there, and I wasn't a part of a lot of that history, but there's clearly a lot of emotion associated with this. My focus is get everybody looking forward, get them back to work, improve that relationship. I met with the union leadership my first week on the job, and I said we've got to improve the relationship, and I'm committed to do that. And nothing's changed in that regard. So when they're back on the floor, I'll be back on the floor, helping improve that relationship.
You guys are in the process of cutting about 10% of your workforce, roughly 17,000 jobs. That'll happen over the next couple of months. If this strike lingers on, will there have to be even further job cuts?
Well, I think you should separate the job cuts from the work stoppage right now. The realities of our business is we're overstaffed for the forecast of our business going forward. So we need to right size and be efficient. And I think we need to continue to do that as we go forward. Obviously, the later that the strike ends, the more impact that will have in terms of how fast we're able to recover.
You've got the potential filing for $10 to $15 billion in a capital raise. You haven't made the decision on when you're going to do that. Is the ending of the strike, is that sort of the key thing? Once you get that in place, you have the certainty that you can say, okay, let's go forward. I guess what I'm asking for the investors, when should they expect you guys to make that decision?
I don't think it pivots on the timing of the strike. I think we've got a good plan to raise, and so we'll execute to that plan. You've seen that we started to do some things here to get prepared for that.
What's up? What's up? We got 3 minutes until the stock market closes. All right, you got some Boeing news there. Boeing's had earnings today, this morning. So let's check out what we got so far. Semiconductors dropped for most of the day. So that's Boeing stock right there, BA. But let's look at semiconductors first. Despite bad news in Texas Instruments, it still popped. It popped about 4% in pre-market. So it's going to end the day roughly 4% anyway. So there you go. So nothing much there. But despite that, everything else went down. We got NVIDIA, like it faded. And after the close, we have LRCX Lam Research earnings. That's what everyone's waiting for. We'll see what happens there. It already fell from ASML earnings last week. So I don't know how bad they could say things to make it go down further, but I'm betting that it won't. So I bought here on the dip because that's where I drew that blue line right there. That's basically resistance and support way back in September, Friday the 13th, right there. The cyan line, and it was held as support in October 1st, and looks like it held again, but that's no guarantee. And we have Tesla earnings after the close in about an hour or two. Earnings call will be 2 hours from the close. So one more minute. Let's see what else here. Okay, bonds. Yes, it's still in that blue region, still hanging around the bottom. So these are long bonds. And small caps. Yeah, we're still in this range. It's going to take a while to figure that out. Don't know how that's going to go. We're going to need more earnings, I think. And what else? QQQ. So NASDAQ, again, it bounced off of this support, which was set in June 18. That was resistance. And it became a critical area because, it gets really close to there, bounces down. A lot of congestion here between September 18th to October 7th. So that 486 on the QQQ NASDAQ 100 ETF, very important. It bounced off again, and we are waiting for Tesla. So market is closed. S&P 500 fell with that. So SPY ETF 577.93. That's the close right now. Okay, guys. Now we're going to wait for earnings from Tesla. Let me zoom in here. Let's look at crypto. So it tested just below the 65.74 area. You can see here this congestion region, the structure that was built around the summer from July 18th into July 31st. So that was the end of the quarter. After the end of the quarter, we see like it just completely fell apart, went down into August 5th. So again, everything is quarter by quarter, and we are starting a new quarter since October. You see here, it fell after the end of the quarter from September 30th into October 1st, held that support that was set by the first day of trading in that quarter. We went up, tried to hit 69. Now we're falling back. So this may be a prelude into Halloween, where it'll try to get to 72,000 for Bitcoin. All right. Now let me play this Bitcoin video for you guys. Or crypto. Crypto. This is pretty interesting. And I do have a crypto article, very interesting.
Back today after getting close to 70,000. We've heard a lot about Bitcoin in the presidential campaign, but it's also playing a role in local down ballot elections. Mackenzie Sigalos is here with us. Mac, what you got?
Hey, Tyler. So with 2 weeks to go until the general, fresh election data for September shows that crypto PAC money is focused on close House races as part of an effort to push candidates favorable to the group's agenda over the top. Now, Fairshake, which is the leading pro-crypto super PAC and one of the top spenders across any industry this election cycle, has funneled a big chunk of its final donations to close House races in 8 states, including New York, Nevada, and California. And several of those races are considered toss-ups by the Cook Political Report, and more than 70% of those donations are going to Democratic candidates. Now, all in, crypto groups have spent over $130 million in congressional races for this year's election, including the primaries. And what I will say is that a lot of that money is going to Senate races.
Well, I was going to ask you, where is the Senate figure in this at all, and who's collecting there?
So you had $10 million apiece going to the candidates in Michigan and Arizona. And then overwhelmingly, the vast majority of this money, $40 million, going to vote out the Senate banking chair, Sherrod Brown, who hasn't been very favorable to the industry.
Wow.
He's Ohio, am I correct?
In Ohio, yes.
In Ohio.
We're also seeing a lot of crypto spend in the presidential race. Kamala Harris getting $12 million from the crypto billionaire, Rich Larson.
All right. So a little bit her way as well.
Mackenzie,
Finally.
thank you very much.
We got some other news about crypto. Let me pull that up. I think this is pretty damn interesting. So let's see. I found this very compelling. Okay, let's go here. All right, I put the link in the chat for you guys. Okay, you got the link. All right, guys. U.S. Department of Defense places Bitcoin soft war thesis under security review. Rockets priced to $300 for that book. The retroactive review signals DoD's understanding of national security implications within Lowry's thesis on Bitcoin as a strategic asset. Oh, yeah. Oh, yeah. Jason Lowry's book, Soft War, a novel theory on power projection and national strategic significance of Bitcoin, has been retroactively subjected to a security and policy review by the Department of Defense, DoD, affecting its distribution and availability. The review of a published work by a serving military officer raises questions about the government's potential alignment with national security protocols. Further, the DoD's decision to place the book under security review may suggest it fears other nations adopting the theories it sets out and wants to reduce its publication to ensure U.S. dominance in the area. As a U.S. Space Force officer and research fellow at MIT, Lowry explores in Soft War the concept of Bitcoin's proof of work mechanism as a form of cyber power projection. He argues that Bitcoin could serve as a strategic asset for national security, proposing that its underlying technology may transform cybersecurity and modern warfare. The DoD security and policy review process is designed to prevent unauthorized disclosure of classified information and ensure that published materials do not conflict with established policies or compromise operations security. Typically conducted before publication, such reviews assess content related to military operations, technological advancements, and national security issues. The retroactive nature of the review suggests the DoD may have concerns about sensitive information within the book that could impact national security or reveal protected insights. This action has resulted in limitations on the book's availability, mandated revisions, or other restrictions until the review concludes. Physical copies of Soft War have reportedly become scarce, with prices increasing to over $300 due to limited supply. All right. Awesome. Awesome. And guys, if you did not get that thesis before the DoD did that, you can definitely find it online. And if you guys noticed, there was an issue with Internet Archive. Like, it had a hack happen maybe 3 weeks ago, probably 3 weeks ago. So the copy archive there is now unavailable since it got hacked, so that you can't find it there. Now, if you want to find it, now I'll tell you where to find it. It's basically, you go to LibGen, LIBGEN. Go look up LibGen. It's a Russian website. You can download the previous versions of it, so get it from there. I'm not going to tell you anything else, but go there if you did not download this in time. All right. So, very interesting. Crypto will definitely be an interesting thing moving forward, and telling people how to pirate. Hey, bitch. You want freedom of speech, right? You want freedom of speech, don't you? You want them? They already shut down Internet Archive. There you go. That's your Library of Alexandria moment here, man. They wiped out all your ebooks, didn't they? Oh, now they redacted. Oh, do you want the real version, or do you want versions that are censored? Up to you. Anyway, alrighty. So let's continue on. I think I'll do a little bit more stuff with the charts for you guys. So let's look at Boeing again. Let's look at Boeing. So Boeing. So let's see. So yes, this red line I drew. Okay. So Boeing stock ticker BA. So these were set by the tops of December and March. So December 2013, March 2015. This is the area of contention. So that's how it is. We see a pop on the sort of semi agreement that the unions made with Boeing. We see the earnings pulled it back. Now we just closed right on that pink line. So we still don't know if it will fall back into here. So we still don't know about their debt. Stock issuance. So you heard that in the beginning of the video where they were talking about like asking the CEO, when are you going to issue the stock? So that news might be baked in. Like people already know there's going to be stock issue. We just don't know when it will happen. They have an idea of how much it'll be. So according to this, like I don't expect it to really drop below 139 anymore, but it could possibly head down there when the news hits. So when the news hits, that's the last bad news it will probably have. Drop there, and then you just start buying it up. So I would be looking at the 140-ish and maybe 145. See how it behaves there, and just try to grab shares if you want a blue chip in your portfolio. The other one is Intel, right? Intel's earnings next week. Now we've already had bad news last quarter. If it stayed above this open, you can see that it stayed above there. So we're hanging out, and we'll see how things go. See anything else? Intel is stock ticker INTC. So let's say this top that was made in January 1997, that's where it's holding, and it didn't go below there except for a couple times really in the dot-com bust ending in around October 2002, and then again with the great financial crisis into March of 2009. So there you go. That's where I'm looking at. So let's see if it drops back to $20. We'll see how that goes. All right. So continuing on, Tesla's earnings, which we are watching. We are watching this. So it closed today at 213.65. Let's see here's this chart I have here. So let's put up a weekly chart of this. So yeah, this gray line here, we are hit that area. If it pops back up to 261 into next week, that'll be good. So next week we'll have all the earnings, all the big fat earnings next week. This is where the Nasdaq really has to fight. So let's see. We got AMD, we got Intel, we have Microsoft, you got Google, you also have Amazon and Facebook. That's right. You got those. Those are your earnings. Okay. So let's look at QQQ again. So the NASDAQ. So here we had that support at 486 for the QQQ. It hit that. Then you look at semiconductors, reviewing this. It hit the support set in 223 SOXX ETF. And then you have another ETF for semiconductors, which is balanced differently than SOXX. This one, you see here, okay. And then I'll put another resistance. I'll probably put another resistance here. Yeah, you can see that around set in September 27th. So it's kind of hanging around here. And you already see its weakness. You definitely see its weakness. So if you look at the 65-minute chart, you see like it dropped all the way down to the bottom. So SMH at 247, it climbed back up to 255, faded that. So that was a TSM earnings. It faded it. It was weakening since last week, and then finally collapsed down here. So this area, major support. If it falls through here, then yeah, look out below. Look out below. That's where you're gonna have to buy it. All the way down. Yep. Anyway, let's continue on with another video. Here we are.
Apple's Tim Cook is in China, second time this year, meeting with officials pledging increased investment in that country. And that comes as the iPhone maker is facing increased pressure in the world's largest smartphone market. Deirdre Bosa watching all of that in today's Tech Check. Hey, Dee.
Hey, morning, Carl. So if you think, like many investors do, that artificial intelligence is the most, or at least one of the most important parts of the Apple investment thesis, then you really want to pay attention to what is happening in China. Cook's visit comes just a week before the launch of Apple Intelligence here in the U.S. Meanwhile, its most important Chinese rival, that's Huawei, it's not waiting around. Just like they front-ran the latest iPhone announcement, the company is once again front-running the release of Apple Intelligence with its own AI features through an upgrade to its Harmony OS. That's its operating system. Now, according to a demo from the company that it posted, it uses in-house AI to do things like translate text, edit photos, carry out more autonomous actions like ordering a coffee without needing to actually touch the device until you get to the payment part. Now, this is all the more notable because the first wave of Apple Intelligence, it won't be available in China, and Apple is already on the back foot. As we have pointed out before, Apple fell out of the top 5 smartphone players in China earlier this year. And I want to emphasize the second column on this image. Go to Huawei, take a look. It's growing its market share 41% annually. Not only has it pushed Apple further down this list, so it's out of this list, but it's quickly widening the gap. Now, so far, some of that has had to do with folding smartphones, which are hugely popular in China. Apple, of course, doesn't offer one at all. Huawei, meanwhile, a few months ago, not only has foldable phones, but it added a tri-fold, triple fold smartphone to its lineup. And now Huawei is pulling ahead on the AI front, while Apple is left searching for a solution to a much bigger problem. Now, the backdrop is this. Beijing has banned foreign-developed AI models like ChatGPT, so Apple may have to secure a local partner to power those AI features, raising questions around data sovereignty and privacy. This is likely a topic that Cook is discussing with Chinese officials this week. In a social media post, China's industry and IT minister said that Cook stated Apple's commitment to investing in the country and said that he would support the development of supply chains, all while he's trying to diversify over to India. Finally, guys, one last point. I want to underscore that Huawei is blacklisted by the U.S. government. So not only is it growing its smartphone business and reducing its reliance on Western technology, but it's also China's best hope of catching up in semiconductors, which we know is critical to the AI arms race. A research firm, Tech Insights, discovered that Huawei's latest AI servers included chips made by TSMC, and that, of course, is NVIDIA's key manufacturing partner. Guys.
All right, so we got some of that. And, you know, Tim Cook likes to visit China all the time. I think he visits China and even talks to their president more often than U.S. presidents do at this point. That's how important China is. And so that consumer market, very important for future growth for any international multinational company like Apple. Now, the other thing to talk about is you saw that chart there. So let's go back to that chart. So let's go back to that chart.
But it's quickly widening the gap. Now, so far.
So you see at the bottom of this, annual growth, 17% Xiaomi. So Huawei is not traded anywhere. And even if it was, you wouldn't be able to probably because the U.S. would ban it. They definitely don't want to support Huawei. But Xiaomi, I talked about several times already in the past week or so, the Chinese stock. So let's bring it up. Go back here. And let's go look at Xiaomi. Xiaomi Corporation. Yeah, SY. Yes. So this is the Chinese stock that you probably should be thinking about having because it's one of the few that go up quite nicely. I believe another one, EDU. I think they had earnings. Didn't they have earnings? Yes, though they have earnings and it went down. Perfect. So I will be watching this one too. EDU, I'll have to talk about another time. This one does tutorials and things. So like studying for standardized tests in China, but the government kind of restricted them from doing that. because only rich people would pay so much money to have all these tutorial sessions, and you know, China's all about trying to, at least at the face of it, try to look like they're all about equality, equity, and all that stuff, right? So they don't want that. They don't want that image. But in any case, it has recovered quite nicely from those times, having a bottom at around $10 in May 2022. The business has adapted to teach other things. So, you know, they'll do tutorials like play piano, play the flute, and all that bullshit. So so I'll talk about this stock some other time. So if the Chinese recovery is happening, this is one of these stocks where they just explode really nicely. So you can see it goes from $10 to $100. So that's a 10x right there. Risky stock, but hey, you know what? You want to make fast money, you got to do the risk. So this is one of those type of companies. So it already had earnings. It dropped. Let's see where it goes, bottoms out. If it gets cheap enough, get down there. You can buy it, see if it goes back to 200 eventually on the pump up. Now, okay, we're done with that. Now let's look at how aftermarket is doing for stocks that matter to me anyway. So we already got some results already. So Lam Research, our LRCX, very nice. So it looks like I bought correctly and bought semiconductors back, and it is pumping. Now we see SOXL, the 3X ETF. I bought down here. Okay, you bought at the bottom of that trend range, and you took a risk. That was a gamble. Looks like it's going to pay off into tomorrow. I'll dump it there probably because that's just a quick scalp. And you got Tesla up 7.58%. So it already has results. So unless Elon says something stupid in earnings call in 1 hour, I think we got a NASDAQ rally into next week. And next week, again, we will have tons of companies that will report. All right. So very nice. See, let's go to the next video. Let's see what I got else. Oh, yes. Starbucks had a surprise earnings announcement yesterday after market hours. So it wasn't supposed to report earnings, but it had bad news. So let's see if I have that video for you guys. Here you go.
On Starbucks, Kate Rogers has details. Kate?
Hi, John. That's right. Starbucks is warning and reporting early for Q4 here, also suspending its 2025 guidance. I'll take you through the numbers we have. The company reporting it expects 80 cents adjusted. That is lower than the $3 estimated by analysts, expecting revenues of $9.1 billion, also lower than the $9.38 billion that analysts were looking for. Same-store sales expectations down 7%. The company saying its results for this quarter primarily driven by softness in North America, which we know has been a key issue. Revenues, particularly in the quarter, specifically a 6% decline in U.S. comp store sales, driven by a 10% decline in comp transactions, partially offset by a 4% increase in its average ticket. Also, China, another problem area for the company. Comp store sales declined 14%, driven by an 8% decline in average ticket, compounded by a 6% decline in comp transactions. They're noting it's weighed down by intensified competition and also a soft macro environment in China, which we've been talking about in previous quarters. New CEO Brian Nichols saying in a statement here, our fourth quarter performance makes it clear we need to fundamentally change our strategy so we can get back to growth, and that's exactly what we're doing with our Back to Starbucks plan. They will be reporting next week on October 30th. It's the first quarter where we're going to hear from Brian Nichols in greater detail about his plans for the company. But as you can see, the stock is lower by nearly 4% on this report. Guys, back over to you.
Kate, how much of this is kitchen sinking? I mean, I think about Cal Ortberg over at Boeing, new CEO there a couple weeks ago, pre-announcing with Boeing and taking all the charges. Is this a similar situation given the fact that Starbucks has been struggling?
Certainly, Morgan, and it's a change in direction. Remember when Jim Cramer interviewed its former CEO, Lakshmi Narasimhan, last quarter, he said, why didn't you come out and warn? Why didn't you let people know that this was going to be a tough quarter? It looks like the company is getting ahead of that with this messaging ahead of its results next week, and also saying, we're suspending this guidance for next year, and we're looking ahead to our Back to Starbucks plan, and that's what we're going to be focusing on. So definitely a change in direction with the new leadership.
So, Starbucks didn't do bad, actually, today. Let's see. Let me pull that up. So, yeah, it dropped in the open, but it climbed back up. So it ended the day on the green at up 0.87%, closing at 97.66. So it's still in this range set by August 13th of this year. So this looks pretty bullish. And I believe they're getting an executive. So the new CEO of Starbucks is getting executive from, I believe, Chipotle. So that's a good sign. Chipotle is a very good company. Very good. They do their business very well. So let me see if that's true. Chipotle, Starbucks. Yeah, let me see the CNBC article here. Starbucks taps former Chipotle executive as global chief brand officer. Okay, this was October 2018. All right. Let me put that on the screen. I'll put the link. I'll read this article for you guys, if you guys care about Starbucks anyway. I mean, Starbucks is a pretty important company for if you want to gauge how people spend, like how much discretionary spending they're going to do, because people aren't going to pay for overpriced coffee unless they got money in their pocket. And that's a good way to look at demand. So let me see. So after hours, NASDAQ still going up. Okay, very nice on that Tesla news. So I think we should pump right into next week's earnings. Very good, very nice. And from there, let's look at Starbucks. All right, so it's a CNBC article. I'll put the link in the chat. All right, you guys got it there. So Starbucks taps former Chipotle executive as global chief brand officer. Okay, all right. That's her right there. All right, Starbucks has tapped Chipotle alum. Okay, Tracy Lieberman as its global chief brand officer, a newly created position. Oh, it's a new position. And the latest executive change, guys, let me zoom in, under Brian Niccol, after he left Chipotle and took over as CEO of the coffee chain last month. In Niccol's first week on the job at Starbucks, he outlined his plan for turning around the chain's slumping sales in the U.S. For the past 3 quarters, Starbucks has reported same-store sales declines for its home market, as its occasional customers buy fewer macchiatos and refreshers. Among 4 top priorities Niccol described in his plan was improving the company's branding. He wants to remind customers about the chain's coffee expertise and its special coffee shop experience, according to his open letter. Starbucks is a brand people love. It's time to tell our story again and reintroduce Starbucks to the world. Tracy is the perfect person to help us do that. She has a proven track record of building strong brands, developing compelling products, creating great customer experiences, and leading breakthrough marketing, Niccol said in a statement Friday. Niccol created a similar global chief brand officer role at Chipotle when he took over there at 2018. Okay. Now, I think, this Starbucks is Chipotle is a pretty good company and stock. So let's revisit. Let's revisit Chipotle. Yeah, Chipotle, CMG. Okay. Yeah. It recently had a split, so it got cheaper. It used to be like $1,000 or something. Let me see. Yeah, it had a 50-to-1 split. Yeah, it used to be really expensive. So 50. Oh man, it was crazy. Yeah, it was $3,000. That means if it's 50 times 60, all right. Yes, it was over $3,000, man. But yeah, if you guys bought it around 2018, so he took over here 2018 where it was $6. So this new CEO comes in, and guess what? It goes from about $6 to $7 and jumps up to $7, right? $70. $70. So that's a 10x. That's a nice 10xer right there from 2018 to 2024. So if this guy can do the same thing with Starbucks, well, I don't know. That maybe that's a little bit too hard. But hey, let's look at Starbucks stock. See, it's been going sideways. Definitely not a fun stock to hold as an investor. But if SBUX is Starbucks, but if you believe in this new CEO, oh no, this is not the right stock. Chipotle CMG. Okay, yeah. So yeah, you see that it's like this is nice. This is definitely a nice company stock to own during his tenure as CEO of Chipotle. All right, guys. Let's see what other videos I got for you. Let's look at this bond one. Yeah, let's look at this bond one. Here we are. Here's the video.
That's to our talk of the tape. With key earnings and the election in front of these markets, what is the best way to position right now? We will ask Lauren Goodwin of New York Life Investments back with us here at Post 9. Everybody's trying to figure this out, right? What the best positioning is with yields backing up, the election a couple weeks from today, tech earnings next week. What are you feeling?
Well, I think it's important for investors to keep in mind that underneath all of the risks and changes, we are coming off of a Q3 economy that was way above trend growth. That's a ballast, a support for the equity market that I think can get us through this sort of pre-election time period. So there's no economy problem, and that's really important. As you pointed out, though, our view on risks is that as we get closer to the election, what might be the biggest risk to the equity market is a rates problem. And so expectations that spending, inflation, growth might be higher than the market expects are actually the downside view for the equity market.
So even if rates are going up for the right reason, you think it could be a problem if they get above a certain level? I have some firms today saying, well, look out for 4.5%, maybe even 5%.
Yeah, so on the 10-year, I think 5% is really the go, no-go line when it comes to the equity market. But when I think about the economy, really more of like a Fed funds rate of 4%. So if the Fed's able to cut just a couple more times, I do think that allows for cycle extension, provides a really nice balance between little extra oomph for borrower health, but you still have an investment rate that's attractive for those that are investing. You still have an economy that's chugging along. That's a really nice Goldilocks level. If we get to a policy rate that stops before 4%, that's where I think 2025 starts to look a little more precarious.
Do we need to start planning for a so-called reflation trade, like Paul Tudor Jones told Andrew Ross Sorkin this morning on Squawk Box that he was doing? In the context of that, I want you to listen to what he said PTJ did about one particular trade that he doesn't like. Listen.
I am clearly not going to own any fixed income, and I'm going to be short the back end of fixed income because it's just completely the wrong price.
So if you guys don't know this dude, Paul Tudor Jones, is one of the best hedge fund managers ever. So Paul Tudor Jones, and I've mentioned Stanley Druckenmiller. He's another one. So these two guys you got to listen to. And I'm going to play the full interview with Paul Tudor Jones at the end, towards the end of this section where I go over the videos, because I'm going to go through it further, because he said some very, very interesting things. And I think a lot of stuff you will not catch if you don't understand what he's saying.
In other words, plan for the reflation trade. Rates are going to continue to go up in a manner that people didn't expect. So that's what he wouldn't do.
I have an agreement and a disagreement.
Okay.
My agreement is that duration is just not my favorite place to take risk. I agree that rates risk, especially in the long end, is absolutely there, especially when you have a binary event in the election that might drive market expectations one way or another. And what I'm saying specifically is that if you have a sweep in either direction, the likelihood of more government spending, more inflation risk is absolutely there. So we prefer in credit taking shorter duration exposure. And if you want to balance that shorter duration exposure with long duration, take it in the muni curve, which is disinverted. Where I'm not 100% in agreement is to avoid credit altogether. Strong economy, good credit quality across the board, even in the high quality segments of high yield, certainly in the municipal and investment grade markets, you just have very low default risk. And that's not a circumstance where rates volatility, I think, disrupts the medium term return potential.
If I told you that, okay, rates were going to remain elevated, and maybe they even creep higher than here, but we know the Fed's cutting rates. Who cares if it's slower and smaller than we once thought? Economy's good. Atlanta GDP 3.4, at least now. And there are a lot of people predicting animal spirits are coming in the M&A market, which has been dormant for a while. Isn't that enough to overcome whatever risks are out there?
It could be very close to enough. Again, I think that it's important that the policy rate moves a little lower from here because it gives borrowers a breath of relief, allows the cycle to extend. But that is an environment where if rates have come off just a little bit, even if they're still, let's say, moderate for a moderate amount of time, that's an environment where historically both credit and equity have performed well in public and private markets. That's an incredibly constructive view for the markets moving forward. The one thing I will caution, though, in a conversation that I'm having constantly with investors right now is if that's a relatively constructive outlook, then I'll just wait till after the election. I'm not going to do much. I'm not going to make much allocation change even into 2025. And that's where I caution investors that after a couple of years of higher than average growth, much higher than expected average, much higher than average equity returns, a year of good returns for both equity and credit might actually feel not as great as it's felt, right? And so there is returns for both equity and credit might actually feel not as great as it's felt, right? And so there is still an impetus, a catalyst for change in allocation that we think is important.
All right, guys, that's enough of that. Okay, so let's go back and look at where we're at in the aftermarket with all these earnings coming out. %8 on Tesla right here. Right here, SOX L up 1.67%, on Lam Research up 4.78%. So NASDAQ, I think, should do well tomorrow unless Elon says something dumb in 1 hour. So let's go back and look at another video. So this is from the Wyckoff guys. So let's see what they said last week about the S&P 500 and see what we think now.
There was a lot of hidden demand right here. Then we still have this hidden demand, and then demand is consistent, but it's not anymore as aggressive as it was right here. So expectation is that we're not going to expand easily as we did on the first leg up. And then look at what we have on the third leg. So it's the same idea, some demand right here. And then look at the demand signature. It's diminishing now, right? Yeah. So I would be thinking if we're going to go down and we're going to test this area right here and just wait for the election.
Okay, it went by pretty quick, but you saw that. Go back here.
And just wait for the.
So you see all that. Look at all that drawing right there. I wish I could zoom in on the StreamYards thing, but I can't since I'm playing this on the StreamYards. But you see that congestion. Once it moves up, it's gonna fight. That's what we're seeing right now. That's what we're seeing right now on the S&P 500. So we're starting to see that. I believe we are starting to see this. But at this point, I don't believe we'll have a serious crash unless the rumors that it'll take 3-4 days perhaps to do ballot counting for all the mail-in ballots. If it takes way too long to decide a winner for the presidential election into Jerome Powell, who talks in 2 days after the election, if Jerome Powell talking that day still doesn't know who's president, that might create so much uncertainty that we might have a temporary major dip going into Jerome Powell's press conference. So be aware of that. But at this point, I do not expect anything major unless not tomorrow. Next week's earnings for all those major companies I mentioned: Intel, AMD, Microsoft, Google, Facebook, right? And Amazon. All those companies report crazy bad earnings for some reason. Like everything starts flushing down, then yeah, okay, fine. That's where we're going into election day is a bad or really bad panicky market, then fine. But if it's not like that, then yeah, it'll be more of this sideways confused motion. So let's see. Now let's go look at this recent video. Let's look at the more recent video here.
Supply comes in again, and now the bars are diminishing, and there is still some supply here. Again, I would not be surprised that we are in this structure right here. And going into the November, we have something like this. This is still in line with the idea that we come to the most important bar right here on the break that was already overcome by the Fed bar. We are staying above it. We're staying in this area right here of this bar and absorbing whatever supply is coming in.
Okay. Once again, go back.
This area right here of this.
Look at that air. So you see what he does. He looks at that first red bar, or second red bar, actually, the biggest red bar at that time. And it sets that range. So he expects the NASDAQ to pull back to 20,000, NASDAQ 100. So let's look at the chart. Let's see where we're at right now. Excuse me. See where we're at right now. Yes, we're at 20. Yes. So we did hit that, didn't we? Okay, so yes, we are kind of in that 20,000 region right now. We bounced right off of it already. So, yes. Okay, that's very nice. Okay. Let's look at the QQQ here. Yeah. Let's get a clean chart. Okay, congestion. Okay, so yeah, that looks fine. So go look at the QQQ. See, that's what is set here. Okay, so yeah, I think we completed that action already. We've just completed that action. So that means, according to that chart, maybe we're gonna go back up from here. All right. Okay, very good. And the videos that I play, all the links are in the description, so you can go there and see it. Now, let's continue on. We're going to talk with Paul Tudor Jones, okay? So this dude, you should definitely listen to. You can look him up, Paul Tudor Jones, Tudor Jones, Jones.
Though,
Okay.
because that's how the money is going to get raised,
Correct.
one way or the other.
Correct.
I think we have a screen, if we could, that puts up a little bit of a menu here.
Yes.
Of, I don't know if it's options. Actually, they may not be options
No,
at all.
there are plenty of options. There are plenty of
but
options.
there's not many ways to get where you need to go unless you start to do some of these things.
Correct.
Maybe. So the question is, of what's on the screen, you can let the tax cuts expire. That
Well,
gets you
look, can I just say
billion.
this?
Yep.
You have to let the tax cuts expire.
You have to.
Yeah, you have to let those expire. That's $390 billion. We're going to have, again, we're gonna be broke really quickly unless we get serious about dealing with our spending issues, and unless we can either. I don't know if we'll be able to cut spending that much. 60% of our spending are transfer payments.
But if you think we're going broke, and you think Trump is going to be the president, he's not going to let those tax cuts expire if he can avoid it.
The thing
he does not want the corporate tax rate to go to 25%, as you're suggesting it'll have to. He's suggesting it should go to 15%.
I'm saying that just to get us to the point where we stabilize debt to GDP at where it is right now, here's what you need to do. You need to let the Trump tax cuts expire. That's $390 billion. You need to raise the payroll tax on every single working person, 1%. That's another big slug. You need to...
What do you think that does to jobs?
We're clearly going to have a period of contraction, which hopefully, that's why I was going to say, it's going to be really important for the Fed to be able to offset the fiscal contraction area that's going to come.
Then you want to increase the individual tax rate all the way to the top rate of close to 50%.
Now, hold it.
Yep.
I don't want to do any of this stuff. What I'm telling you is that we've got to be serious about where we are fiscally. And so I'm giving you, there's a whole set of options, right? We could go in and cut 25% of the federal workforce. Some people may do that. There's a website where you can go look and play with all the options. You can raise the capital gains rate from 21 to 28%. That only gets you $10 billion a year. It actually doesn't get you what you need. So I'm simply showing some of the things that you can do. Yes, you'd have to raise the tax rate on the top, I think probably everyone over 200 grand, probably have to raise that to 49.5%. If you do all these things, raise the Social Security from 65 to 70. If you do all these things, means test, Medicare, if you do all these things, all you do is you get to a primary balance. What that means is you stabilize debt to GDP. You're still actually increasing your debt.
Right.
You're still actually increasing it because it excludes the interest costs, which, oh, by the way, the interest bill this year is larger than every single line item except Social Security. It's larger than defense spending, larger than Medicare.
I want to talk about why you're here, which is Robinhood and this conference. But before I do that, is this, given all of the things you're saying, are you off buying gold and Bitcoin and
I think all roads lead to inflation. We're going to end up,
but does all roads lead to inflation, therefore gold is a good investment? Is Bitcoin a good investment to you?
I'm long gold. I'm long Bitcoin. I think commodities are so ridiculously underowned. So I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great. It's probably some combination. I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that. And I would own zero fixed income. If I had my cash, it'd be very short term. The playbook to get out of this, you see it in Japan right now. They have 2% inflation, 30 basis points overnight. They don't want to raise rates. The playbook to get out of this is that you inflate your way out and you have a small tax on the consumer and you run interest rates and nominal growth rate, interest rates below inflation and nominal growth above inflation. And that's how you reduce your debt to GDP. So you're going to have the Fed they should be easy. They should be
easy. You want them to cut.
So just real quickly, every 100 basis points, given where our debt to GDP right now, every 100 basis points is worth about $90 billion a year to the deficit. $90 billion. So yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can without letting inflation become too much of a tax on the citizenry. So yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debts.
Well, I think I can't sum it up any better than that. So let's look at another video.
Are here in downtown Soho, joined by a very special guest this morning. Paul Tudor Jones is here. He's the founder and chief investment officer of Tudor Investment Corporation. Of course, he is also the founder of the Robin Hood Foundation, which is hosting its annual investor conference in partnership with JP Morgan right here. That's going to begin tomorrow, and we're thrilled to have you on the program.
So good to see you again.
So good to see you. We got to talk about a lot of things because we are now 14 days away from the election, and I think everyone is trying to make sense of this market and where things are headed and where things are going, and maybe, depending on who you think is going to win the presidency, how that's going to impact this. So where are we?
Well, for me and in the hedge fund world, this is kind of the macro Super Bowl coming up on November 5th. And I think this one, you know, some elections are not that binary. This one is binary, not so much because of which candidate wins, but it's binary in the sense that what is the market's response going to be to either candidate if they win? And so we can either continue down the path we've been on, which I'm going to kind of frame here in a second, or we may have that point of recognition where all of a sudden the markets have different ideas than what the candidates have been espousing. So
before you lay out where you think that piece of it is, let me just ask you this. So Stan Druckenmiller said that he's convinced by market indicators right now that Trump will win. And I'm curious if you agree with that thesis. Part of it is that he's looking at, you know, Polymarket and the betting markets. Part of it is he's looking at the shares of
So I mentioned Stan Druckenmiller to you guys. The other hedge fund I mentioned that's into Palantir. I also mentioned the Polymarket betting crypto website, funded by Peter Thiel and Ethereum founder. Ethereum, you should know, Vitalik. I forgot his name already. And so, yes, this is very important stuff to tie into here.
EGT, part of it he's looking at Bitcoin.
Mm-hmm. Yeah, certainly the markets are saying he's going to win. I think they're heavily skewed by Republicans, so I don't know if I necessarily believe the betting markets, but I don't have any great insights. I really don't. I just would be more skeptical of them than I would normally. It's the same way, look, in football betting, right? You can get a huge home bias where the line doesn't reflect reality. So, yeah, I know what they're saying, and I respect them.
But what about other investors? Dan Loeb recently came out with a report to his investors saying that he's positioning or repositioning his portfolio around the thesis that former President Trump will become the president.
And I have also, if I'm being honest, primarily because I see the polling numbers have clearly moved in this direction.
You say also, meaning you've repositioned as if former President Trump wins.
Yes,
You have.
I've moved in that direction for sure.
And what does that mean?
It just means more inflation trades, which I'd love to get to, but I think it's really important that we frame where we are right now, and where we are is an incredible moment in U.S. history. And what I really want to talk about is the debt trajectory that we're on. So we've gone in the space of 25 short years from debt to GDP at the federal level from about 40% to almost 100%. 60% in 25 years. And if you look at what our trajectory, what CBO projects our trajectory to be, as well as what we see as and we're going to project further than CBO. So I'm going to show you a chart. This is debt to GDP. So CBO says that we go from 98 to 122, I think 124. That's very conservative over the next 10 years. If you extrapolate that 30 years, you get to 200% debt to GDP. And so that's something, obviously something that can't go on forever, won't. And the question is, after this election, will there be some point of recognition, particularly with all the tax cuts that are being promised by both sides and the spending plans? I mean, they're handing out tax cuts like they're Mardi Gras beads, right? We're doing tax cuts on everything from tips to toucans. So it's crazy what's being promised. After the election, I think the fact that you've got 7 to 8% budget deficits as far as the eye can see, the question is, will the markets allow either candidate? I think under Trump, the deficit goes up by $500 billion per year. Under Harris's plan, it goes up by an additional $600 billion plan per year. I have a feeling all those are just pipe dreams. I think the chances of any of those being enacted are...
You mean that the tax cuts that they're putting on the table during the campaign?
Those have zero chance of being enacted in my mind. I think the markets will, the debt markets for sure. The Treasury market won't tolerate it. So...
Why do you think that the Treasury market continues to tolerate it now?
Well, you know, it's so funny because financial crises percolate for years, but they blow up in weeks. That's kind of the history of them, right? And so for me, this election becomes one of those seminal points where all of a sudden, let me really think whether this proposition that the U.S. government is making me is something that I actually want to participate in. And I just want to, try to frame in layman's terms. Let's assume that I'm making $100,000 a year. You've lent me, because we're such great friends, $700,000. Mm-hmm. That's what you've lent me. And I come to you and say, okay, Andrew, I'm going to pay all that back to you in 30 years. But between now and when I ultimately pay you back, I want to borrow $40,000 every year for the next 30 years. And then at the end of 30 years, I'm going to pay the whole thing back. Would you lend me that money?
Unlikely.
You son of a bitch.
Right.
I thought you were my friend.
Well, this is...
Well, there you go. Yeah, I thought you were my friend, China, Saudi Arabia, Japan. Why don't you lend me that money?
The problem that we have.
Okay, so that's actually the proposition that the U.S. government makes to every bondholder today. That's the exact same proposition. So think about this. We owe $35 trillion. Our tax take is $5 trillion. So we owe 7 times what our tax take will be this year. Our revenues will be this year. And our deficit is $2 trillion, and it's $2 trillion right now as far as the eye can see. That is literally the proposition that the U.S. government is making to someone who buys a 30-year bond.
So I'm not disagreeing with you. The question is, life is relative. So some people would say, sure, you can either buy bonds from the U.S. or you could buy bonds from some other country that has an even worse situation.
Or you cannot buy bonds.
At all.
Right. So anyway, I was watching this Vince McMahon documentary, and in it, and I loved wrestling, particularly when Stone Cold and The Rock and all of them. So in it, there's a term that I'd never heard of called kayfabe.
So he pronounces it kayfabe. I think most people pronounce it kayfabe. But here's your wrestling metaphor today.
In wrestling parlance, that represents the unspoken, unwritten, tacit agreement between the wrestlers and the fans about the illusion that's going on in the ring, the suspension of disbelief that what's going on in the ring is actually, we know it's scripted and we know it's a performance, but they ask us to think it's genuine and real.
And so that's what you think this is?
Yeah, we're in an economic kayfabe right now. And it's not just the United States, we're in it in the UK, in France, Greece, Italy, Japan being the biggest of all. It's this economic kayfabe. And the question is after this election, will we have a Minsky moment here in the United States.
Remember that term, Minsky moment. I think I'll cover that right after this video.
In U.S. debt markets, will we have a Minsky moment where all of a sudden there's a point of recognition that what's going to happen or what they're talking about is actually fiscally impossible, financially impossible?
So are you betting on a Minsky moment?
I am clearly not going to own any fixed income, and I'm going to be short the back end. I am clearly not going to own any fixed income, and I'm going to be short the back end of fixed income because it's just completely the wrong price.
Okay. So that is Paul Tudor Jones, and he's one of the best, if not the best, trader along with Stanley Druckenmiller. So these are the top dogs in hedge fund history. And what he said there was he would not buy that back end. Back end meaning the long part of the curve, the treasury yield, the debt yield. So I think we're in a couple times, maybe we talked about the curve of the bond market, the duration, things like that we've mentioned before. So long, meaning bonds that are 20, 30 years out versus the short end of the curve, meaning T-bills, meaning your savings account, which tracks that kind of. Well, unless you do a savings account in the big banks, which gives you ass low amounts of APY, annual percentage yield right there. So unless you got a high yield savings account from a credit union or something like that, that's closer to a T-bill, whose durations is between 1 month to 1 year, the short end of the curve. Yeah, I mean, he doesn't want to buy those bonds. Doesn't matter. Those bonds are trash. And I think he's implying that, it doesn't matter who wins the election. You see, you're just going to get more debt and you're just going to get more inflation, which is what that woman was saying several videos back, right? And that's why I mentioned to you guys about gold over treasuries, gold over TLT. So even though I don't expect a TLT, I am long the TMF right now because I think it's going to be in a trading range for a while. It's not going to collapse anytime soon, I don't think. We are still at a moment where things could go wrong. So we'll see. We'll see how it goes this election cycle. But that treasury yield better not be pumping or we're screwed. Yeah, what's up, San Jose? What's up, HB? Yep, so let's look at TLT. TLT is here. So this blue line is a line of no return. We don't want to crash through here. Otherwise, the rates will raise too high, and the whole stock market will just eat shit. Dixie. So Dixie is the dollar index. You see the dollar going strong. That's why I'm still short China, this currency pair here, where I mean, the Dixie is mostly US to Euro. Yeah, that's pretty much a proxy for that. But still, you got to look at this area, right? Once it gets back to 105, you don't want it to go any higher through 106, 107. That's bad for the stock market too. So you don't want yields to be too high. You don't want the dollar to be too strong. Okay, everything is about a Goldilocks, and this is why. Yeah, we don't want this TLT to get any further down because. So the trade right now, let's see. So 10-year yields are 4.24. So those 10-year notes, 4.24% to borrow. So that's what the cost, the interest that the government has to pay right now. You don't want those dollars to be too strong either. We've hit a low here. We bounced back. I think this was because of the yen collapse here in August, and well, I mean the yen strengthening. My bad, yen strengthening, dollar pushing down, collapsing, and then now this is reverting all that move from August. So we're back. We're right back where we started. Let me see. So TMF is the key thing I'm playing. So I've been buying since it just touched 50. So I've been buying. So I think for now, I'm not saying gold is not the play to make, but I think gold has exhausted itself. Silver as well. See silver here down 3% today, 3.33%. And so I've been selling my EXK since Monday and then Tuesday. So we're right back where we are here at the top of this area. I'm not sure if how we're gonna do it, but let me see if I got my zoom in here. So yeah, this cyan line is important. Yeah, this was set around March of 2012 and again November 2012. So this resistance. So remember, guys, you look at a chart, you go to the left, you look at the left, you see where it is, and now we hit it. And guess what? We had trouble getting through it. So, this is not nothing new. This is nothing new. This is easy to determine. You just look at a chart, you go like, well, where was it back in those days? Where did it have trouble getting over? You'll see it having trouble going over again. And this is where we are now. And I think we should make a range between the 34 and 32 area. So if we keep mostly in the upper half of this area between $30 an ounce and $35 an ounce for silver, we'll be good for next year. But yeah, I think we're done for now because the BRICS had a meeting. So gold kind of pumped into that meeting. So they're meeting in Russia right now, the BRICS countries. So that I think we've exhausted this move. So watch for a pullback. Gold. Let me look at the futures market for gold. It's $2,729.6 dollars an ounce for gold right now. So yeah. Anyway, I think that's good. That's good. Okay, I think that's it. So let's see. I have one more video. I think this is a good segue for this video. This is more technical analysis stuff. I think these guys do a really good job. So you should watch it. Definitely should watch it.
Don't forget to like, subscribe, and hit that notification bell. Hey guys, thanks for joining me. And the contents of this podcast, in my view, are going to be incredibly important for your trading and investing over the coming years. If you haven't already cottoned on to what's going on in the markets, a lot of what we're about to see in the charts I'm about to show you is kind of hidden a little bit beneath the surface. But by the time this becomes obvious to everybody, for some, it may be a little too late, particularly by the time people take action on what they're seeing, because they won't want to believe what they're seeing. It's the same problem that catches people out every time this happens, and we're getting a signal from the charts now that is delivered maybe once every, I don't know, maybe once every 15, 20 years, something like that. And in fact, this signal has only been delivered 3 times so far in the last 100 years. So what am I talking about? I'm talking about capital rotation, of course. Now, this is a phrase that I sort of conjured up a little while back, kind of unaware that it was sort of a phrase that is already being used or had already been used. I hadn't really heard it being spoken about previously, although I was aware of cyclical behavior of stock markets and precious metals. So as time has gone by, I've developed a series of charts that have been pointing in one particular direction for what is coming next. And if you follow me on social media on X, then you'll know that back in 2019, I was able, even with the techniques that I was using back then, to point to what was going to happen to gold in 2019 and 2020, and then what would happen for the following 3 years, and then what would happen when that consolidation process came to an end. So if you look at my feed on X, you'll see that forecast that I issued back in 2019, which is now complete with gold hitting the mid 2000s, $2,700 plus, of course, now. So what's going to happen next, and why is it so important, and what is capital rotation, and how does that tell us or help to tell us exactly what's coming? Okay, I'm going to share my screen now, and we'll get straight into it, and I'll try and keep this as clear and as straightforward as I possibly can. As I always do, I'll try to explain myself in a way that if you don't know very much about technical chart analysis or stock markets and precious metals, that you will hopefully still be able to understand what I'm talking about. So I went on to ChatGPT and asked it, right, what is the definition of capital rotation? Capital rotation is the movement of investment capital from one sector, asset class, or region to another based on changing economic conditions, market trends, or investment opportunities. Investors and portfolio managers engage in capital rotation to optimize returns, reduce risk, or take advantage of emerging growth areas. The strategy involves shifting assets between sectors or industries that are expected to perform well while reducing exposure to those that are likely to underperform. Now, that's very important. Just remember that. Those that are expected to perform well and those that are likely to underperform. That's critical because fund managers, the guys with the big bucks, the big money, are well aware of what I'm about to show you, and they are already doing this. For example, in times of economic growth, investors may rotate capital into cyclical sectors like consumer discretionary, technology, or industrials. Conversely, during economic slowdowns or uncertainty, capital may rotate into defensive sectors such as utilities, healthcare, or consumer staples. Now, they're talking about S&P sectors there. In this context, I'm talking more specifically about stock markets versus precious metals. Okay, that's the capital rotation I'm interested in here. Now, types of capital rotation, you have sector rotation, geographic rotation, asset class rotation, and thematic rotation. Well, really here I'm talking about sector and asset class rotation primarily. Geographic rotation less so, and thematic rotation does play into this as well. Different themes rising and falling during their cyclical bull markets and bear markets. Capital rotation is a dynamic strategy that requires continuous market analysis and a forward-looking approach to where value and growth opportunities are shifting. Okay, now what I want you to take away from that is that capital rotation is something that you can identify, and we can identify it using technical chart analysis, comparing one asset class with another. Now then, let me just show you my chart, and I'm going to switch my video camera off just so that you don't get distracted with a picture of me in the corner. Okay, that's my video camera off. Okay, right, now then, this is a series of charts that I would argue identify and define the capital rotation that I'm talking about. And what I'm talking about here is when stock markets are in a bearish trend, and the biggest performing alternative, the sector that gains the most is, or sectors that gain the most, are precious metals and commodities, perhaps energy as well. Okay, now this series of charts, as they begin to break down versus gold and enter bear markets versus gold, then it is a sign that capital rotation is taking place. So this is US M2 money supply to gold. In simple terms, if you haven't got a great understanding of technical chart analysis, when the chart moves down and breaks below clear support, then we enter a strong gold bull market era. And you can see here on the left-hand side, during the early 2000s, this chart dropped a lot and gold went up 600 or 700%, or maybe even a bit more. We've then had a period from 2011 roughly to 2000 and let's say 22, where the chart was rising. So it wasn't really supportive of a precious metals bull era. But now the chart has broken below the moving averages, below this red and green splodge, which is something called the Ichimoku cloud, which acts as key support. So effectively, we've broken through support levels and we're now in a bear market. So we are, and I drew this chart back in 2022. So before we had moved all the way down here, I put this orange arrow on the chart and said that we are likely to see a huge gold bull market. Now we've moved from $1,600, $1,700, $1,800. We've moved up by $1,000 to $2,750 so far. So everything that's happening at the moment confirms what I suspected on that chart. This is gold versus CPI. Okay, so when this chart moves to the upside, when it breaks out to the upside, it means that gold is outperforming CPI, consumer prices, a proxy for one way of defining inflation. So when gold is outperforming inflation, it puts you into a gold bull market era. And you can see that from 1970 through to 1980, when gold doubled, and then it doubled again, then it doubled again, then it doubled again, this chart was moving up. So this is a gold bull era with a chart moving up. Then from 1980 to roughly 2001, the chart went down and gold was in a bear market. Okay, then it broke out and we got a signal here that we were in a bull market, and gold broke out versus CPI and rose. Now we've had a consolidation period effectively actually since 2011. Gold went into what I would call a mini bear market, although it doesn't quite fulfill all the requirements of a full-on bear market era. But nevertheless, gold fell from $1,900 to $1,050. That was a big drop. But I would argue that this whole period has been a consolidation on this chart and on the gold chart, and that this breakout here puts us into a new gold bull era. Okay, rotation of capital. You can see the capital rotation events. The green ones are in favor of gold, and the red ones are when capital rotates in favor of other asset classes, not gold, and primarily the stock market. So red, you get into the stock market. Green, you get into gold. Red, you get into the stock market. This black one here was an indeterminate signal that gave a bullish signal that we would go up to test this resistance line, but then we consolidated again for another 3 years. We've only just broken out. So that's the green signal. The green signal because we're above the moving averages, above the Ichimoku cloud, and we're broken out above the main overhead resistance level. So this chart is telling us capital rotation is in force. Gold versus PPI. Gold versus PPI is on this quarterly chart. Let me just adjust the resistance line. On the quarterly chart, it's broken out. We are in an uptrend above the 12 and 36 period moving averages. We are above the Ichimoku cloud, and gold is in a bull market versus producer prices. PPI is producer prices. So the signal from this chart is capital rotation is taking place. The capital rotation event is now in full force. The Dow to gold ratio, very, very important chart, this one, critical chart for everything that we're looking at. I'm just going to minimize the right-hand stuff there and just expand the chart. So signal number one, in 1930, the chart broke down. This is gold versus the Dow Jones versus gold. So when the chart goes up, the Dow Jones is in a bull market and gold isn't. When the chart goes down, gold is in a bull market and the Dow Jones isn't. When it goes up, Dow's in a bull market, gold isn't. When it comes down, gold is in a bull market and the Dow isn't. Okay, so we.
All right. Yeah, I think he goes into quite a lot of detail. It probably is a bit confusing once you get more and more into his thing. But as you can see, he likes to use a lot of ratios. Okay, so all these charts are ratios. All right. The first one was M2 money supply. So I'm gonna go back there.
What I want you to take to the most
So you
is
see the money supply. So money supply over gold. Okay. So that's a ratio. And then the other ratio
1,050.
did
That was a big drop.
gold over CPI. And I think this, highlights a lot of what I've been trying to say about secondary indicators, looking at relationships. And that's why I've been going through a lot of material with you guys, because you need to understand things when you're looking at ratios, right? If you're just looking at random ratios without having at least some basic understanding of why one would outperform another, you may get really lost very quickly. So yes, I could tell you like, oh, just look at this candle, look at this price, look at the chart. But when you're looking at ratio charts, you got to understand the relationships of why things move in opposite directions or together, because they might give you false signals. Okay. They don't work all the time. And I'm relying on a lot of people here doing analysis where you're looking at this plus giving a backdrop to it. So you heard those hedge fund guys talk, and then you look at like the ideas of, oh, what is a credit spread of the bond market and things like that. You have to take everything together, all these things together when you look at these secondary relationships. So, okay, you could trade with just pure charts, just looking at, okay, this candle's moving this way, that way, just from the price perspective, right? From the S&P 500, the NASDAQ, or the semiconductor index, something like that. But we got to understand more deeply than the surface level when we start looking at ratio charts. Okay, so anyhow, I don't know how much more this video is quite long. I'll probably revisit it again, but the link is in the chat. Okay, I'll move forward. I'm just gonna move it forward because you guys can watch this the whole thing yourself. Because okay, I'm gonna go here. 17 minutes.
70 to 100.
So he goes over the U.S. dollar index versus gold, the Dixie I mentioned earlier.
Okay, so capital rotation confirmed from both of those charts. This is the US dollar index versus gold. Okay, the US dollar index is a basket of currencies that measures the US dollar relative strength. It's primarily the euro, actually, more than 50%. I think it's about 58% of the DXY is made up of the euro. So DXY has fluctuated between, I don't know, off the top of my head, something like 60 and 160. Don't quote me on that. But anyway, for the last 50 years, DXY has been oscillating in that range. Sometimes it's stronger than other currencies, sometimes it's weaker than other currencies. But the point is that if gold, or sort of put it the other way around, if the US dollar index cannot outperform gold, it's telling you that whatever relative strength that the US dollar has, it's being beaten by gold. And each time this chart moves down, you have a huge gold bull market. The chart moving down tells you that the US dollar index is underperforming gold. Therefore, any relative US dollar strength is not able to outpace gold. And that's a particular indicator, a particular sign of underlying gold strength, which you get in a gold bull era. Even relatively small moves to the downside can send gold up 60%. But when you get a long period of this chart moving down, gold moves up hundreds of percent. Now we've just broken down again below what I call the sleep mode line, and that's when the chart goes into sleep. In other words, any upwards trend is ended. You see this upwards trend, upwards trend, upwards trend, and it broke below the sleep mode line, and the ratio sort of goes to sleep, if you like. It's any bull market moves for DXY are over. So even though the US dollar index has been doing well recently, and it's moved from 70 to 103 or something like that over the last several years, gold has gone up by many, many hundreds of dollars in the time period that the DXY has gone from 70 to 103. And it's because there is no overpowering US dollar strength in relation to gold, and quite the opposite now. And during this little breakdown here that we've had so far, gold is up 68%. And because we're broken below the sleep mode line, as we did here, my suggestion is that this chart is telling us we have a capital rotation event on our hands. Critical information. The equal weighted S&P, strip out the weighting that is given to companies like Nvidia, for example, which in a way kind of distort the S&P and what's really happening. This is the equal weighted S&P versus gold. And when the chart moves up, stock markets are in a bull era. And when the chart moves down, gold is in a bull era. So you can see during this period here, as the chart was moving up, gold fell from 400 to 250. But then when we had capital rotation, we went from 250 to 450 to 1,000 to 1,900. So gold doubled to 500, it doubled to 1,000, and then it almost doubled again to nearly 2,000. Then we had another capital rotation in favor of stock markets, and gold went from 1,900, it actually went to $1,050. When we touched the edge of this inverted arc here, it's $1,200. And at that point, the bear market in precious metals was effectively over, and it's just a waiting game for the consolidation period to play out and for this chart to break down. And it is now broken down below the moving averages, below the Ichimoku cloud, below this final support line. And we've moved from 1,200 gold to 2,700 gold. We're going to move to 5,000 gold and then 8 to 12,000 gold.
Okay, that's pretty crazy. Pretty crazy price projections right there. $12,000 an ounce. Okay. And maybe in about 10 years, so 2034, we'll get about $12,000 an ounce. That's quite a prediction.
This is the roadmap for the equal weighted S&P versus gold. So this is telling us capital rotation is taking place, and that rotation is away from stock markets towards precious metals. Now, if we look at the S&P versus gold, and if we look at NASDAQ versus gold, they haven't quite broken down yet in this fashion. And that is because, as I say, we have the MAG 7. So let's look at the MAG 7, and let's start, shall we, with Tesla. Tesla has been in the bear market versus gold for a long period of time now. I'm just going to get rid of this volume on the right-hand side. I'll get rid of the volume at the bottom because we don't need it. Tesla has been in a bear market versus gold. It broke down, and that told us, or gave us, additional evidence that we were in a capital rotation event. Now let's look at the rest. Google versus gold, breaking down, okay? Rising support line, break below support, back test, back test, back test, breaking down below the moving averages, pushing down almost below the Ichimoku cloud. We're already below the rising support line. There's a horizontal support line here that we're in danger of breaking through now. That will be a breakdown. That will be another one of these to get a red flag, which will tell us that we're adding more evidence to capital rotation taking place. Amazon, rising support line, wedging into a decision point below the moving averages. The 3-year moving averages are already turned down below the Ichimoku cloud. This is bearish, and a breakdown here would be a confirmation of capital rotation. Apple versus gold, also showing signs of breaking down. It's failed to break out above horizontal resistance. We are now below the moving averages. The 12-month moving average is bearishly crossing below the 3-year moving average. So that is giving us a setup for a downside move to confirm capital rotation. Meta is one of the two charts that is not yet strongly suggesting capital rotation. So Meta is holding up above rising moving averages, above the Ichimoku cloud. Only a move through this red zone here will be the final nail in the coffin for Meta. Microsoft is giving capital rotation confirmation. We've broken down, we're below both moving averages, and we are trending down below the, well, we're in a trend that will take us down below the Ichimoku cloud for final confirmation of capital rotation. Nvidia is the other one that hasn't broken down versus gold. It continues to look strong. If this behemoth ever breaks down or fails to break out, then that will be a problem. It carries such a weighting now in the stock markets. It's a multi-trillion-dollar company, something like was it 3 trillion, something like that last time I looked. The metrics aren't on here for some reason. I'm not sure why. They usually are shown down here. Anyway, moving on to gold versus the S&P. This is these last two charts are the critical final confirmation for capital rotation. So gold versus the SPX. You can see the rotation events, or the last couple of rotation events. Rotation in favor of the stock market. The chart moves up through the moving averages, through the Ichimoku cloud, precious metals bull market, stocks bear market. Rotation in the other direction, precious metals bear market, stocks bull market. Stocks go up by a huge amount, and precious metals fall by nearly 50%. Now, we've been in this period since 2018 where the stock market has not outperformed gold. The ratio has gone sideways. Both stocks and precious metals have been in the bull market. When we cross this red line, the breakout line, and particularly when we get close to 0.5, then we're going to be giving confirmation of a capital rotation event defined by the full weight of the S&P. And this chart is screaming capital rotation event approaching. It's telling us effectively that there are very bright lights coming through the tunnel towards us. And if you don't step out of the way, then you will get flattened. And finally, finishing off with gold versus the NASDAQ. Gold versus NASDAQ is putting in what looks a little bit like a double bottom here, actually, and will probably be the last to confirm by moving through this evidence cluster. That is the 12 and 36-month moving averages, the Ichimoku cloud, and the resistance line. So a strong rollover of NASDAQ and tech stocks is required for this chart to break to the upside. But this looks to me very much like a setup for a reversal and capital rotation confirmation from the NASDAQ. It hasn't given that confirmation yet. It's putting in what looks like a basing pattern, a bottoming pattern, but that cannot be assumed. We have to wait for the evidence. But overall, looking at all of these charts that I've just gone through for you, I think it's safe to say that the capital rotation evidence is now becoming strong from all of these charts that we've been through here.
All right. So I think that gives you an overview. Tech stocks led by the Magnificent Seven stocks, which are reporting earnings next week, except for NVIDIA, will be a big decider in how we go to the next couple years. I think, I feel like gold and the stock market will go up together for at least about a year. And then what's going to happen is that something will break and stocks will fail, and then gold will continue up. That's my thinking. Okay. So we'll see if I'm right. But for now, don't believe everybody. Okay. Everybody's trying to pick teams and decide where things are going well ahead of the critical moment. The critical moment. And that critical moment, like Paul Tudor Jones said, was the Minsky moment. So let's go and go over the definition of what a Minsky moment is. What is a Minsky moment? And before we do, Elon is probably starting to talk in a couple minutes. And let's see. Oh, man. Error loading chart. Come on, guys. Come on, Robinhood. So, yeah, 9.43% after hours. Tesla at $233.80. So, still doing good there. Lam Research up 4.92%. $76.60. Okay, so those are your two stocks to watch for the NASDAQ into tomorrow. So hopefully we get everything good for the morning for Thursday. So let's look at what a Minsky moment is. Let me give you the link to that Investopedia article. You can look it up yourself. Minsky moment. So what is a Minsky moment, huh? A Minsky moment refers to a sudden collapse of asset prices after a long period of growth sparked by debt or currency pressures. Now, what did I talk about earlier? I talked about look at the bonds, look at TLT, and then look at the dollar, the DXY. You don't want them to be too strong or too weak. You want them to be in a range. So you want them to be in a Goldilocks region. Okay? It's at the explosive juncture of an economy about to fall. In finance and investing, sudden and catastrophic collapse of asset prices after a period of growth and stability is known as a Minsky moment, named after economist Hyman Minsky, born 1911, died in 1996. This label has been applied to some of the most devastating economic crises in history. Minsky mostly wrote during a period when he thought economists were lulled into complacency by the relative stability of the mid-20th century. His work was meant to wake them from their slumber. As such, there is an irony that an economist who dedicated his life's work to developing policy solutions to avoid financial crises has his name applied to the very moments he sought to prevent. All right. Several decades after his death, after so many crises, we might not now be in a Minsky moment, but we seem to be in a Minsky era. Okay. Let's go look at something. Yeah, this article is pretty long. It's really long. Let's see. Pretty long. Man, but yeah, this. All right, let's read from this paragraph here. Minsky's work describes how periods of economic stability can paradoxically lead to greater instability in the long run. This is very important. According to Minsky, more investment generates higher profits at the aggregate level, all else being equal. While this is a positive sign for most investors and the public, it can make the financial system more unstable. When profits continually exceed expectations, servicing debt becomes easier, encouraging firms to borrow ever more sums. After all, in a booming economy, profits from speculation outpace the interest to be paid. As Janet Yellen put in 2009, when optimism is high and ample funds are available for investment, investors tend to migrate from the safe hedge end of the Minsky spectrum to the risky, speculative, and Ponzi end. All right. Very nice. I think that's a very good paragraph right there. This leads us to Minsky's famous categories of credit: hedge, speculative, and Ponzi. Let's define these. The hedge finance stage. In this economic period, borrowers can repay their debts with revenues or cash on hand. They have enough cash flow to cover both the principal and interest on their loans. The speculative finance stage. Borrowers can still pay interest on their loans but must continually roll over the principal. They have no choice at this point but to rely on the assumption or hope that they can refinance or borrow new funds to cover their principal. Then the Ponzi finance stage. Borrowers can only repay their debts by increasing their debt or selling borrowed assets at fire sale prices, since many are in the same position and the market knows you must sell, giving you no bargaining position. Borrowers don't have enough cash coming in to cover either the principal or interest payments on their loans. They can now only rely on the appreciation of their assets or the willingness of lenders to provide additional funding. Once an economy reaches the third stage, if prices don't go up and lenders stop lending, then the Minsky moment arrives. Okay, all right. Okay, guys. Yes. I think that's a very, very good section of this article. I don't think I need to read much more, right? All right, yeah. Yeah, you guys can read the rest. This is a lot of stuff here. Yeah, there's a lot of stuff. Wow, they go through all the examples. Yeah, very nice, very nice. Okay, let's look at this. World debt levels in 2024. Like, so that's what Paul Tudor Jones was talking about. More recently, the International Monetary Fund, the IMF, has joined a chorus of those issuing warnings of high global debt levels and the potential for a financial crisis. While this has not yet come about, there are warning signs. The US has had an extended period of economic prosperity, rising debt levels, and speculative market activity as the S&P 500 and Dow Jones Industrial Average have broken all-time records. Nevertheless, speculation does not seem to be at the extreme levels that presage a Minsky moment, though time will tell. So yeah, we're not there yet. We're not there yet. We'll see. We'll see. So let me go. Oh, okay. Elon's starting to talk. Tesla is now up 10.67%. We're at 236.35. Okay, guys. Very nice. Now, usually a stock, when they have earnings reports, the CFO, the chief financial officer, when they start talking, they're kind of more downbeat. They won't hype things up like the CEO usually is, especially when you talk about like somebody like Elon. Elon's always going to hype stuff up. And so the CFO is going to be talking very boring things about the debt, about how their cash flow, their margins, things like that, which will sour the stock market a little bit. So after the CFO starts talking, then usually you'll see the price pull back. Maybe if he's talking very dry and tosses a wet blanket over everything. But you know, the Q&A also is very interesting because Tesla's Q&A is usually they're going to ask some crazy stuff and Elon might say some crazy things, but yeah, we'll see about that. I think a couple times Elon just didn't want to do any more earnings calls. He was like, let's let the CFO talk or let someone else take over for most of the and Q&A too. He allowed some non-institutional investors to do ask some questions. So yeah, it's always weird on the Q&A of Tesla. So you never know. You never know. Let's see. Lamb, nothing going on there. So yes, I think that's good. SOX L at 34.37 after hours, 1.7%, 1.73%, and we'll see how China does overnight. Because if Tesla says good things about China, you know, that'll be good. It'll be bad for my Chinese short positions. I'm still holding Yang. So yeah, I mean, whatever. I'll keep holding them just in case Donald Trump wins and the Chinese market takes a dump pretty quickly. So let's look at this article here, since we're talking about bubbles and Minsky moments. And I'll give the link over. Here, there's your link. So this is the same dude that had the blog about gold over TLT, the ratio, how gold, he's long gold and short bonds, 20, 30-year bonds. Okay, that's his pair trade. It's called a pair trade. I don't have time to talk about what pair trading means, but essentially it's like you take one position long and another position short. So you don't just do one type of asset that you're long or short in. You do both. You try to say like this one will go the opposite of this one, so then I'll do both sides of that, and they don't need to be, you know, correlated in any way technically, but you can choose to do that. So that's called pair trading. Anyhow, is peak semi the real deal? Semi meaning semiconductors. Peak oil was never a real thing, but maybe peak semi is. So as hard as it may seem now, peak oil was a big thing around 2007 or so. As the oil price surged, the idea was that all the easy oil had been extracted and that oil production was headed for a period of decline and high oil prices would be with us forever. Okay? So I think this is I don't know what index this is. Is this like a Google search index? Where it's like a lot of people are searching peak oil around 2004 to 2007, and then they stopped being interested in it. Okay. Of course, economics and finance suggests that high prices will attract capital and innovation and eventually drive supply. This is exactly what happened as the US shale revolution turned the US into an energy exporter and flooded the market. So this is United States Department of Energy crude oil total production data. Okay, so it went up since 2007, right? You see that? The chart is moving up all the way into COVID-19, and we've moved back to that level since just before COVID started. The best shorts are cyclical businesses. Okay, I have to explain what cyclical and secular is later, but okay, you understand cyclical meaning like an airlines. So this is why I always hate airline stocks, because airlines is a cyclical business, meaning that it goes up and down in cycles very readily. Like you don't have a trend. Okay, like so when people have a lot of money, you're in a good mood, you go travel a lot, then you know that has ups, you're in the up cycle. But then when people run out of money, they don't want to travel a lot, it's kind of the economy is kind of depressed a little bit, then yeah, they'll stop traveling. Then you'll see this go up and down in cycles. And also you'll see like the oil prices fluctuate, also affects the airline industry a lot more. So things like that, you don't like that. So you don't want cyclical businesses. All right, that's when you invest in businesses like that, you have to know where the cycle is. Otherwise, you'll just go nowhere. Essentially, a lot of times you'll go nowhere. The best shorts are cyclical businesses that people believe in are secular stories. So I think another example of this is semiconductors right now. Semiconductors used to be very cyclical. Okay. So back in the 90s, when like they were tied to probably Microsoft releasing a new operating system. So the 90s, it was like that. So if Microsoft was releasing a new operating system, people would buy new PCs because they said, oh, you need more requirements for your PC. So you had to buy a new PC, make a new PC or something like that. So parts like RAM, CPUs would fluctuate with Microsoft release schedule. After the 90s, then it got a little muddy because then we start seeing people make more, go into data centers. So it sort of started in probably the teens. So 2010s onward, we started seeing more and more business go into making data centers. So you stop seeing cyclical behavior in some stocks, like starting with Nvidia, right? Oh, also like games. So Nvidia back in the 90s also was very dependent on what new games came out. So very cyclical, very cyclical. So now you see Nvidia doing the AI stuff, but before they were going into scientific computing. So that was one of the first things that led them to not be so cyclical. And then you start seeing more in the data center. So a lot of CPU usage. So Intel stopped and AMD stopped being so cyclical. So you start going there. And so the only sectors in semiconductors that are still highly cyclical is you look at memory, like Micron. So you look at Micron stock, compare that to Nvidia or AMD, you see the difference, right? So that's where it's happening. Okay, so a lot of people, they like to short stories like this. That's what he's saying. They like to short, oh, this is going to change the game of this industry. So people who believe in all this hype and the hype never materializes, that's why he's saying that you got to short it. So kind of like the .com thing. The .com thing in the 00s, right? We're going right up to late 90s into 00. It was like boom, the aughts. It was like, boom, you got, oh man, there is no .com revolution happening anytime soon. And then all those companies just collapsed. So that's why, and it just pulled all the tech companies with the semiconductors down. So anybody that believed that, okay, this was the end of the cyclical way the businesses usually ran, and they went for that thesis, they got burnt, right? So that's when you shorted. So that's what he's saying here. Cyclical businesses just need prices to rise high enough to attract competition. To my mind, semiconductors and oil seem to have a lot in common, essential for economic growth, but just need the occasional period of high prices to incentivize supply and capital investment. For me, TSMC, with its transparent pricing, seemed to be a good place to look for signals. And in recent years, pricing has surged. I thought the surge would then see a period of decline like we saw from 2002 to 2011. Just like I said, right? So after that .com hype died, it was all over. There was no more of this secular story. And then only when we got to 2010 up, we started seeing changes happening in the industry, where people started doing more data centers because people had smartphones. It had to connect to the cloud, things like that. This is where it all started. And the AI is just like another add-on to this type of level of work, where everything has to be tied to the cloud. You know, you got to hook up your computer to the internet now to run any applications. A lot of times, a lot of these apps are run remotely, right? Man, that reminds me, there was a Larry Ellison interview back in the 90s. He talked about this. Oh man, I got to find it. It was on PBS. Like, it was in the documentary in PBS, where Larry Ellison, the CEO, founder of Oracle database. So he was saying, like, he hated PCs. He hated personal computers because it's like trash. It was like, oh, you have to buy a CD-ROM. You got to put it into your computer to install software. He hated. He was kind of presaging what would happen in the future, where we went to the cloud. So before PCs, you have to remember, people had terminals hooked up and connected to a mainframe computer. And usually those mainframe computers were like at the government or at your private business. You know, this is not for home usage, right? People didn't have money to afford big mainframe computers, so they would have to have a terminal to log in. So you would have these dinky little like computers that did nothing. All it did was connect you, like back in the old days of dial-up, where you connected directly to your computer at the work. That's all it was. Nowadays we have this cloud. It's kind of like return to that idea where your computer really can't do anything locally anymore. Most of the time, it's going to be offloaded to some bigger resource outside. So that's where all this demand for growth is coming from. Okay. So now I am not so sure. So now he's saying, he wanted to short semiconductors, but maybe it's not right. So this is the TSMC wafer and ASP. I forgot what the heck is ASP. Oh my God, he didn't define it in this article. Oh Lord, he didn't define it in this article. Okay, I gotta look up what ASP is. ASP. So this here, TSMC wafer is the blue line here. Wafer shipments. ASP. Oh man, what is ASP? I don't think I'll find it. What the heck is this acronym about? Average selling price? Is that what it is? I'm not a business guy, so I don't know a lot of acronyms. Yeah, so is that the average selling price? Yeah, okay, that's the average, because he's talking about price. So the ASP is average selling price. All right. Yeah, I'm not no MBA, so anyway, part of me put the recent surge in semi pricing down to the US effectively kneecapping Chinese semiconductor industry. Surely for an industry as innovative and competitive as semiconductors, surging pricing should soon turn to bust, as it did in 2001. However, reading of recent economist briefing on semiconductors, I realized I was fooled. As a regular reader of TSMC quarterly reports and the continual movement to lower and lower telemetry, I thought innovation in the semi industry was moving as it had always done. However, as the economist shows, the node names now along man he messed up here. The node names no longer match up with the actual improvements we are seeing. Unlike oil, there has been no breakthrough technology. We have been operating at peak semi since 2010. Okay, so he's saying that, like oil, we had fracking because the prices went up so high. People develop new technology to take advantage of that higher pricing in the commodity. But in semis, this still hasn't happened. So you see this, the node name here is the gray going down. And, we got to do more streams about semiconductors so I can explain this to you. So this is like Moore's Law. Okay, Moore's Law, where you have smaller and smaller transistors every generation of technology. And right now we're stuck. You see, this is the actual physical gate length of a semiconductor. A semiconductor is measured with the gate length. Okay, so a semiconductor is a MOSFET. That's a transistor. And a transistor has a gate, a source, and a drain. I don't have time to discuss semiconductor physics with you guys, but the gate size, the length of it, determines how big those semiconductors are. You want those little semiconductors to be as small as possible so you can pack as much features into your cell phone. Okay, you want the area size to shrink, right? So you can put more and more things, the real estate on the chip and a wafer is dictated by that gate length. Okay. So, and in contrast to the oil industry, the semiconductor sector has been the place to be. Okay, you see that the chart for the semiconductor index, the Philadelphia Semiconductor Index. There has been talk of some technological breakthroughs to drive more improvement, switching from silicon to nanocarbon or quantum computing, but nothing so far. If peak semi is real, and it looks that way to me, and AI is real, and my interactions with ChatGPT are leaning that way, then absent a recession, semiconductors will continue to do well. What is similar to peak oil is that semiconductor industry requires a new technology to add capacity. While there is plenty of investment, so far no transformative breakthrough has occurred. Perhaps the most interesting thing about peak semi is that AI is driving increasing power usage. The performance of U.S. utilities, and particular nuclear-focused utilities, shows that a connection between computing and power prices is beginning to be established. Now, this last paragraph is so interesting. So I'm zoom in so you can read this last one. Can surging investment into AI eventually cause power prices to rise to a degree to force much tighter interest rates policy from central bankers? Maybe, but I don't know. But what I have learned is that if the best shorts are cyclical stocks that people believe are secular growth stocks, then the corollary is looking true. Cyclical stocks that turn into secular growth stocks are the best longs. Nvidia and semiconductors are fitting that bill, and maybe now utilities too. Boom. Yeah. What did I say? I said utility stocks. Boring utility stocks, didn't I? That's exactly what's going to happen. That's exactly what's going to happen. So, again, we will discuss this further some other time, again and again, I'm sure. Now, this comment is so nice. Maybe this will go over people's heads here, but I'm going to read this comment here that someone put. How ironic that a manufacturing, albeit very complex, capital intensive, and high tech sector ends up hitting neo Malthusian constraints rather than an extractive industry, i.e., petroleum. Perhaps the Prebisch Singer thesis was right after all. In the last 20 years, the industrialization of mostly China drove the price of raw materials to all-time highs versus that of capital goods. Might this trend structurally reverse? After driving the terms of trade against itself, China and Japan, South Korea, and Taiwan might now gain vis-a-vis Russia and Saudi Arabia. So the author replies, Russell Clark here, I don't know, but I like the thinking. Okay, that is probably very esoteric, very esoteric. I don't want to go over this right now, but I definitely will save this thinking for later, because you guys should like look up Neo Malthusian, what that means, and you should look up Prebisch Singer thesis. Very interesting stuff. Very interesting stuff. So maybe we'll revisit it one day. So we'll see. Yes, Latino for Trump. Happy birthday, Portia. And remember to like and subscribe to the Urban Landlord at the Urban Landlord. Okay. And we have the Halloween contest. So remember to send Portia a Cash App for her birthday and another Cash App for the Halloween party that we will have, costume contest on the 31st, 9 p.m. Central Time, 10 p.m. Eastern, ladies only. All right, there you go. This is a 2-hour mark. Let me put up the banner. Let me put up the banner, right? So yeah, it's scrolling across there, the Cash App right there. Portia J. Okay. Portia J. And you can also do PayPal at her email, also on the banner there. Yeah, it's scrolling right now. Portia J, Jaye. That's how you spell it. And Portia at jghb.info. That is the email and PayPal. So if you have any questions too, you can email her. Okay, so let's go and have a little break. Let's have a little ad break.
This Halloween, it's time to turn up the heat and bring those spooky vibes. The John Galt YouTube channel is hosting the ultimate sexy Halloween costume contest, and you could win over $300 in cash. That's right, first place takes home the biggest prize. But don't worry, second and third place will still score big. It's easy to enter. Dress to impress, flaunt your most creative, sexy, or daring costume, and show up to the live stream during the evening of October 31st, which is a Thursday. Come on over on Halloween and flaunt your very best and enter your chance to win the grand prize. Let your imagination run wild. You can be a witch, a vampire, a ghost, a nurse, a cheerleader, anything goes. The more unique and bold, the better. Winners will be crowned based on creativity, style, and those spooky Halloween vibes. The John Galt community will decide who takes home the glory. So what are you waiting for? Get your costumes ready now and come on over to win that prize on the John Galt YouTube channel. Hit that subscribe button, follow the contest rules, and you could be walking away with cash and bragging rights. This Halloween is not just about tricks and treats. It's about winning big on the YouTube channel, The Urban Landlord. It's the only place doing this. Let's have some fun, let's have some laughs, and let's have a spooky good old time. See you there.
All right. Okay. So Elon hasn't crashed the stock yet. It's now 12%, up 12.02%, $239.04 right now. So I think the NASDAQ tomorrow will do very well. Yes. Lam Research, LRCX, Lam Research, up 4.51% still, so still doing well. So yeah, SOXL up 1.73%, and futures are open now. So people are trading futures. Get ready for tomorrow. If you bought today, intraday, you bought at the low, you can sell it, sell your positions, or you can hold them for tomorrow morning and sell them there. So that's a good trade. If you want to do a short-term trade, that was a good scalp. Okay, one of the things I wanted to do last time I didn't get to because we covered so much stuff last time was Monday effect and options expiration. So that's what I'm going to try to talk for the next 30 to 1 hour is go through that topic. What is options expiration right here? And this stuff. So here's the article from Investopedia. I like using Investopedia. Right there, put the link up. Triple witching, definition and impact on trading in final hour. Okay, what is triple witching? So is this some kind of spooky Halloween thing I'm trying to do here? No, this is not what it is. Triple witching is a financial term. The triple witching hour is the last 60 minutes of the trading day on the third Friday of March, June, September, December. So the last month of a quarter. So the third Friday of the third month. So the quarter, okay? Every third Friday of the third month. This is how it is. When contracts for stock index futures, okay? Stock index options and stock options expire simultaneously. Triple witching is the simultaneous expiration of stock options, stock index futures, and stock index options contracts all on the same trading day. This happens 4 times a year, okay? The expected expiration date for the 3 might increase trading volume and cause unusual price changes in the underlying assets. So This past Friday was not triple witching. Triple witching was in September. Okay, we are in October, but we still have monthly expirations on options. So this happens every third Friday of the month. Third Friday of the month. Okay. So now you know triple witching, and now you know that even without triple witching, you'll still have options expiring every third Friday of the month. Now, I'm going to another article now. Let me see if I can find it. Oh boy. Triple witching. Okay. Man, I have so many tabs now. Jesus. Oh my God. Every time I do these streams, I open up a gazillion tabs. Okay. Here's the other one. The problem with this article is that like these images were from a external website, and that has ended. That no longer exists because this was written in 2009. So, sorry, folks. No one saved it. No one archived those images. So I don't know what these images look like. But let's just read what it is. A historical look at day after options expiration trends. It's been a while since I've talked about the day after options expiration, but this particular oddity might be a changing. When is options expiration day? Equity and index options expire after the close of trading on the third Friday of every month. Okay? So triple witching is different. Triple witching is when you have the whole thing with the futures expiring on the third Friday of the third month of the quarter. But every month anyway, there's still something that expires, okay? The options expires on the Friday every month. When the third Friday is a holiday, they expire on Thursday. The day after options expiration then is usually the following Monday. My previous post here and here on the topic could be summed up as the day after options expiration, Monday, has historically been very bearish when expiration day Friday was down, but neutral when expiration day was up. Okay, we can't see this chart. It's gone. The graph above shows the results of 3 strategies trading the S&P 500 index from 1970. The blue made 12 one-day trades per year from the close of each expiration day Friday until the close of the day after Monday. This is our benchmark day after options expiration day. The second strategy, green, only took that position when the expiration day was up, and the third, red, only when the expiration day was down. Clearly, from 1970, the day after options expiration has been very bearish when the market fell on expiration day, but only neutral when it rose, green. But notice what happened more recently towards the right hand of the graph above. The difference between the red and green lines has all but disappeared. Well, we can't see it, so you just have to believe it. The next graph shows the same results as the first from 2000s. In more recent history, it's been little difference in day after options expiration returns based on expiration day. They've both been about equally bad. In fact, in the last year or so, the observation has actually reversed, with positive expiration days leading to the most bearish returns. But I think that's too few observations to take seriously yet. In summary, for most of the market's history, negative monthly expiration day returns beget negative returns the following day, and positive expiration days beget neutral returns. But more recently, that difference has disappeared, and both are now about equally bearish. So let's just simplify that for you guys. All that is telling you is that if it's a Friday, the third Friday of that month, expect the following Monday to be going down for stocks. Okay, that's about it. That's all I wanted to tell you guys. So always look at these key dates. You got like the quarterly end, the last day of trading for the quarter. You got triple witching, and you got monthly options expiration. All these, look at what the price is doing for a stock or the stock index. See what it's doing. So this past Monday was one of those. And what did we see? We see some action that didn't make much sense, but to me, it was no surprise. All right, that's what I'm trying to say, and it shouldn't have been a surprise for you. All right, let's see. Any other articles I had to cover before we go? And I think Tesla should be done with the earnings report pretty soon now. All the earnings call, I mean. The Q&A should be over. Yes, should be over. Oh, I have another article. This is a nice one. This is a new one I found. This one might be very interesting for some of you. So let me get the links for those two articles. Okay, this one, and I'll put it in chat so you guys have it in chat. Yeah. Okay, yeah. Yeah, this one's really nice too. I forgot about this one. I just found this one. This is nice. Nice. Okay, so this is the link for the article I just read. And here's the link for the article I will read to you guys about options expiration. So I think, yes, this will be, this is what this article is, and I'll put it up in the screen. Okay, that's a very nice article. This one is very nice. And before we continue, let me look at what Tesla's doing. Still up, so not bad. It's pulled back a little bit. Lam Research still up too, so nothing's changed. So the options expiration week effect. This was written in June 2024, a more recent article. And this is from Quantified Strategies. Okay, and they have a YouTube video, it looks like. So you guys can watch that, I guess, when you get to this article. The options expiration happens on the Friday before the third Saturday of each month in the U.S. Yeah? An often referred to effect is the options expiration week effect. Okay, is the effect real or just a myth? In this article, we test the option expiration week effect. S&P 500 shows above average returns during the options expiration week. Only July and January shows negative returns during the option expiration week, while April is the best month. Overall, there seems to be an options expiration week effect. Below, we discuss every aspect of the options expiration week and how stocks perform during that particular week. Also, please remember that the week is often referred to as OpEx week. Options expiration week trading strategies. Before you go on to read about options expiration week, we would like to remind you that we have two. Oh, yeah, this is an ad. Come on, guys. Blah, blah, blah. Okay, the first strategy is in S&P 500, SPY, or ES, okay, the futures, and is an overnight trading strategy that takes a position and holds for about 24 hours. The second strategy is a swing trade in the ETFs with ticker code XLU or XLV. It's a trade that holds for a few days given a condition. Okay, all right. So I guess this is all ads, right? Yeah. So this is all an ad. But you guys can see like these people always like give you these like sly little like things. Oh yeah, you see that pair trading and things like that. Yeah. So yes, that's interesting. I think yeah. When do options expire? Okay, you got the triple witching, right? You see here. Third Friday of most months except holidays, triple witching. Stocks, indexes, and index options expire together quarterly. We talked about that. The effect expiring options can impact stock prices. Buy stocks at the start of expiration week, sell on Friday. That's the strategy they want to do. Backtests show potential gains for S&P 500 during expiration week. Since 1990, data suggests potential gains during this week. Okay. When is OPX, option expiration? The options market is fragmented. There are options on futures, equity, or whatever asset there is. However, in this article, we only look at U.S. stocks and equities. U.S. listed stock options expire the third Friday every month. Okay. The only exception is when Friday is a public holiday, right? On these rare days, expiry is Thursday. We already discussed that. What is triple witching options expiration week? We discussed that. Fundamental reasons behind option expiration week effect. The main reason, this is important, for the option expiration week effect refers to a noticeable decrease in option open interest as the expiration date nears, leading to a reduction in both call and put options. Specifically, during these weeks, there's a significant drop in open interest. Now, we kind of talked about open interest for futures in the previous discussion. So go back to that one to look at how it's discussed in terms of futures. But I think it's similar for options with calls and puts, okay? So that's long and short for futures. That's the same idea. As the near-term options approach expiration and subsequently expire, this reduction in call open interest typically corresponds to a decrease in the overall net long call position held by market makers in the market. That's a pretty important sentence, okay? You have to understand that market makers are the ones that sell options to the public, retail, usually to you guys. Now, some people have a lot of shares in stocks and they'll sell options that are tied to what they own physically, but most people don't have the capital to be doing that. Most people are just going to be gambling on options that are sold by the market maker. So, what is OPX in stocks? There are thousands of listed stocks in the U.S., and thus the OPX week is important, despite many just having minuscule options trading. After all, the OPX week stock is about stocks and options. During OPX week, OPX Friday, the end of the week, is the most important day because of imbalances, often labeled pin risk. Guess we'll have to discuss that some other time. Options expiration day creates imbalances. For those of us who day trade stocks and focuses on imbalances, the option expiration days, OPX, are often lucrative. Both the open and close have imbalances that can be preyed on. The hypothesis is that pin risk causes a significant increase in trading activity, but more importantly, more imbalances and abnormal action. Okay. Yeah, that looks like that sentence disappeared. Okay, let's see what's going on here. See more below. All right. What happens when an option expires? To understand option expiration, we need to start by describing what options are. A stock has theoretically an infinite life, at least until the company is bankrupt, merged, or bought by another company. Opposite, options have a finite life. They expire and cease working. How is that possible? For example, Microsoft might have call options with a strike of 120 with an expiry date of the 20th of October. The date today is the 1st of July, and the price of Microsoft shares is trading at 110. A call option means the owner has the right to purchase shares in Microsoft for 120, either before the expiry date of the 20th of October or on the expiry date, depending on the option type. Thus, the time limit is set to the 20th of October. After that date, the option expires and ceases to exist. If the price of Microsoft is less than 120 at the expiry date, it doesn't make sense to buy at 120. This means the option expires worthless. If the price is higher, the owner will exercise the option and buy at 120. So now you have a little idea what options are, right? So that's kind of ties into what we were discussing previously about futures. Futures, I buy a futures contract because I want to buy something in the future at that set price, regardless of how that price is in the cash market. So options is another way of doing this, okay? This means the price of the options varies significantly from how a share price is valued. The value of an option might be more influenced by the time to expiration and or the volatility, and thus the movement can be substantially different from the underlying stock. However, it's not the purpose of this article to go into detail about options pricing. Options expiration week effect in trading. Okay, so this is a image of how they are doing with this strategy, where they buy at the beginning of the week, of the options expiration week, and selling on the Friday, right? Here's an equity curve that incorporates a variable related to the options expiration week, showing an average gain of 0.2%, a 60% win ratio, and a marginal difference between the average winner and loser. Right? How options expiration affects stock prices. The closer we get to options expiration, the bigger the risk for delivery for the issuer. So the issuer being the market maker, right? So they sold you that option. You're gambling with an option. Usually people in retail are gambling with options. Because of this, trading activity in options can have a direct and measurable effect on stock prices, especially on the last day before expiration. So this is kind of like a tail wagging the dog type of situation. All right. Options and futures are derivatives. They're derivatives of the actual underlying asset. Futures is usually the derivative of the commodities, right? And nowadays they also have futures for indexes of the stock. So those are the underlying. And here, options are derivative of the stock itself, the stock prices, and also options, stock indexes. So these instruments are derived from actual things that is happening in the stock market, but are separate from. Okay, hope you guys got that. I hope you guys got that. That's why they're called derivatives. Because of this, trading activity in options can have a direct and measurable effect on stock prices. So I read it again. Remember that. So the thing that's derived from it is affecting what's being derived from. So that's weird. So I can wag a dog with its tail, essentially, is what it's saying. Especially on the last trading day before expiration. Let's briefly look at how pin risk can influence the overall market as well as specific equities. So now we can define what pin risk is. Finally, they got to it. Pin risk at options expiration. Pin risk involves having to take delivery of the shares if you have issued options. For example, if you have issued puts with a strike at 50, you are obligated to buy those shares if the share price is lower at expiration. So go back to the previous discussion we had about futures. So if I had a futures contract, and it went to settlement, so that's what they call settlement, it expired. If I bought a call, then I am going to get let's say I bought a call in oil futures. They're going to send me all the barrels of oil that I theoretically bought, because I bought a contract saying I would agree to take all that oil. If I shorted that future, I got to give oil. So I better have the oil that the other guy on the other side of the trade made. So I have to deliver that oil. Here we got it where it's based off of the price, and you got to have a requirement to buy shares. Okay. All right. So that's the same idea here. Many traders and investors don't want to have the risk of being the owner of those shares over the weekend in case they get exercised. To offset this, they might sell the underlying shares. This way, the price of the shares go up and down closer to expiry as traders take hedges. Anyway, pin risk is a vast topic, but we hope you get a vague. I mean, this example is kind of too lame. I wish they had a better one. Okay, I mean, that wasn't very clear at all. I mean, essentially, the moneymaker buy and sell shares of a stock to push the price up and down. So they have tons of money, and they can push, and they can do this because they have the ammunition to do this. So while you're holding an option, they're pushing that price up and down just to get it to the point where they don't need to be in trouble and give you and get those options in the money. Okay, so we could talk about Max Payne some other time, but the idea is into Max Payne. But let's see. Let's get to this article first. Okay, because of this risk and why the price might be more volatile on the expiration day. Okay, they tried to explain it, but you know, this wasn't explained very well. I think I'll have to find a better article. Based on the assumed positive effect options expiration has on stock returns, we can backtest a simple trading strategy that buys on the open of the options expiration week and exit on the close of the options expiration day, usually at Friday. We own stocks this week and stay in cash the rest of the time. If Monday is a holiday, we enter on Tuesday. Likewise, if Friday is a holiday, we exit on a Thursday. We must mention that the results vary depending on when or how we enter. For example, if we enter on Monday, blah, blah, blah. Yeah, all right. Okay, because most of the open interest in options is in large cap stocks, we test the effect on the S&P 500. Okay, test both and found. We've tested both on the S&P 100 and 500, found minimal differences. We use the ETF with the ticker code SPY when we backtest since inception. We want to emphasize that the options expiration week effect seems to only work from 1990 and later. Before 1990, we failed to see much effect. Now, that's probably because like options wasn't created until the mid 80s, probably about or early 80s. I forgot which. But yeah, people weren't much into options until later. And nowadays it's insane how many people gamble with options. The backtester code for trading options expiration week effect. Okay, the effect is not the easiest to backtest. It's a bit cumbersome to get the correct code. Okay, so we got this chart here. You can read this yourself sometime. The bottom pane shows the number of days to the third Friday of the week. Okay, the number of days. So this is a countdown until that. Okay, blah, blah, blah. The results. Here's the results. The equity chart shows the compounding returns of being only invested in the S&P 500 during the options expiration week. From the open of the week to the close of the week, 100,000 compounded. So this is all the trade. So the CAGR, so the rate of return here, is 2.8%. And the average gain is 0.28%, higher than on any other random week. Keep in mind that you are invested only around 18% of the time, and the average number of bars in a trade is slightly less than 5. As you can see, the effect has been weak over the last 3 years. So since COVID, it hasn't been doing very well. And for the NASDAQ, the QQQ is 0.32% per trade. Okay. So those are average gains per trade. And if you compound it, you get like 2.8%. If we enter at the close of the last trading day before options expiration week, usually a Friday, the average gain increases to 0.35 per trade for the S&P 500. For the QQQ, it goes a little down because of poor performance in 2000, 2001. Thus, we can conclude that there is an options expiration week effect. So it's not random. So there is something that happens during that week going, and then I gave you another article showing you the Monday effect. So there's something going on those third weeks of the month. So always the third weeks of the month, and then the Monday, the following Monday or Tuesday, if it's a holiday on Monday, that's what you got to look for. So this is not random. There is something happening. Okay. So that's all I wanted to talk about. I don't think you can read the rest of this stuff yourself. Yeah, they go into like extreme detail here. Yeah, that's a lot of detail. Yeah, this is how quant traders work. Okay, this is what quant traders are. So, we're technical analysis. That's what I do. But if you want to do quantitative analysis, yes, you can you can go and look at previous data, see what type of trades you can do based on certain effects that you think are happening. So this is what they would do. Okay. So a lot of it definitely ties into options and futures because there's so many things that happen that can be repeated, that is not random. So they're trying to look for these situations here. So this gives you a little flavor of that quantitative analysis. But most of us can't do this at any practical level because all these things are done by the big firms that have tons of PhD students and that graduate. So they take a lot of PhD mathematicians and get them working on this type of stuff to make the money. So you see, it's like, oh man, if I knew that there's a non-random effect every third week, and I could easily just get a point something % more gain that week by employing this strategy, then I'll just do that, right? So every small percentage adds up. And when you compound it, okay, you got like almost 3% gain. Like, I mean, that doesn't sound like a lot, but when you have tons of money and this is just one trade idea, right? There's probably tons of other effects happening all across the world where you could do this for other options markets, other futures markets, everything you could like see. And it's not just like this quad witching expiration effect. You can find other types of patterns. If you can find patterns and you could quantify them and see if they are not random, they actually follow something, then yes, this is one way to do it. You just do in a mathematical quantitative approach like this. Okay, that's good. So 240 is the stream. We're at 240 in the stream. This is 3:30 p.m. my time. 3:30 p.m. my time. Let's see what Elon's doing. Nothing has changed. So I think we're done with the earnings call. We should be done. It's already an hour and it hasn't crapped out yet. So Elon didn't say nothing bad to scare people. The CFO didn't say nothing bad. So we are nearly at 12%, 11.88%, $238.94. Lamb Research still at $76.60 at 4.92% after hours. These are after hours. So yes, I think we're good. We are good for now. So I think I might see you guys later on tonight because I think we have other things to cover. Yeah, I kind of explained the secular to cyclical thing, but I might go into airlines, maybe go into it more, and the whole article about the Singer Prebisch thesis, and then the Neo-Malthusian. I don't know. Yeah, that might be too esoteric. I also had another article about lithium, the USGS. It's up. Yeah, we got some other stuff to look at. We got some tons of things to look at, but I think I'll save them. I'll save them for later. Yeah. No, that's good. That's good. So, a reminder, guys, this is a birthday for Portia. Today's her birthday, so get that Cash App. Hit that Cash App. Portia J. PORSHAJAYE, or you can use PayPal, email at Portia, PORSHA at JGHB.info, INFO. All right, guys. And we have our holiday event for Halloween with the costume party. So give donations and put in a message saying that this fund is reserved for Halloween. So that you hit Portia's Cash App or PayPal and you can send it over there. And let me put up the banner. We have the banner up. If I can find it. Yes, the banner. Portia made that banner, so I'm going to keep using that. The Urban Landlord presents, at the Urban Landlord, Haunted Hotties Halloween Beauty Battle, October 31st, 9 p.m. CST, Central Time, or 10 p.m. Eastern Time. All right, guys. Got it. Ladies, enter for your chance to win. All right. So $300 is the first prize, $150 second prize, $50 third prize. We have 3-hour segments. So we have 1 hour each segment, 3 hours total. Okay, guys, that's how it works. So you can compete on those three. And if we have enough money where it goes above 1,500, and I will match, and John will match, we can go into brackets where the first place winners of those three will compete against each other, or the second, and then we could make them brackets. Hey, put in the money, you'll get more fun, and that's how it's gonna go. We can go all night on this if we just make it work, man. Come on. I mean, all your favorites will be there. You got Grace, right? You got Ava, you got Ruby, you got Lolo, you got man, yes, everybody will be there. Everybody. You got San Jose. Come on. Man, you got Kimmy Cakes. I mean, who else? You got Here for the Tea, right? Here for the Tea will be there. All other girls will be, oh man, we got Beta Kitties. Oh yes. I keep forgetting how many keep showing up. Oh, Kim Jong-un. What the? No, I'm not gonna show my damn face. None of that. No. I am gonna stay anonymous. I'm just a voice. Sorry. You gotta guys get the subscriber counts up, man. You guys better subscribe. We gotta get more subscribers, get more people in the channel, and then we can go from there. Otherwise, I'm not revealing anything, not even a hand, not even showing my fingerprints. Come on. Yeah, right. So, all right, people. We'll see you guys another time. So probably later on tonight, if I got the chance to do it, I'll be back. Later, y'all.